So thank you everyone for joining us today. My name is Micaela Skopnic. I am the Industrial Programs Manager with SBADC. Um, SBADC is a 40-plus-year-old nonprofit organization based in Sunset Park. We support industrial and manufacturing businesses with access to financing, with support with navigating government, with real estate service. We also run the Workforce One Center off of the Brooklyn Army Terminal, so help employers with recruitment and helping neighbors access good quality jobs. And finally, we also work on policy and advocacy for industrial retention in New York City. So I wanted to, with this webinar, we will be kicking off our 4-part series, webinar series, Stabilize to Thrive. It's been a while since we have been thinking at SBADC of trying to provide some more programming for businesses to come together and discuss some aspects that are crucial to their finances and their operations. So part of the work I do at SBADC is focused mostly on financing. And we have worked with many years with Conor McCarthy, who will be introducing briefly. So wanted also give my colleague Brady Meixel the opportunity to introduce himself and let you guys know how he can support you.
Hi, everyone. Thanks for joining us today. Thank you, Michaela. My name is Brady Meixel, and I'm the Economic Development Specialist with SBIDC. I handle our navigating government services. It's providing assistance to industrial businesses with city, state, and federal incentives, discussions with city agencies, and permitting and regulatory compliance issues. I also handle our real estate services, facilitating connections for businesses to available industrial spaces for lease or for sale, as well as connections to real estate brokers and attorneys. I'm going to put my email in the chat, and if I can be assistance in any way to you or your business, don't hesitate to reach out to me. Thanks, and I'll hand it back over to Michaela now.
Thanks, Brady. And finally, just mention that we also have on the line Marie Naxin, Deputy Director of SBADC. So thank you, Marie, for being with us today. So I'm going to hand it off to Conor, friend of SBADC and who has been helping us for some time already with, helping businesses access SBA, some of the SBA products, since Conor, is a senior loan officer with National Development Council. I'll let Conor speak more to National Development Council and what they do, specifically to the Grow America Fund. But it's been great, Conor, to be able to pick up the phone and discuss with you a little bit of what you're seeing in the market, and how businesses are able, or what are the difficulties for businesses in accessing financing at the moment. So, hopefully we can, in addition to talk a little bit about what's available right now, we can also talk a little bit of what you're seeing in the market in terms of businesses accessing traditional lending. And yeah, leave, of course, time for questions towards the end. The idea is that this is a dialogue as well. So thank you, Conor.
Yeah, thanks, Michaela. Yeah, I think this is a wonderful time right now to start thinking about the various types of small business loan products that are out there. And I generally don't like the term small business loan product, but I do think that there's always a silver lining to any crisis. COVID-19 was a massive 2-year-long crisis that still isn't perfectly resolved. But I think the silver lining of that is that it's exposed a lot of business owners at various stages and sizes to different types of loan products that are available. And what I think historically prior to COVID that we've always struggled with is orienting business owners to understand where they stand on the respective steps in their growth and how to size appropriately to a specific loan product. So I think now is actually a wonderful moment, because you can take this moment to start thinking about long-term recovery, long-term stabilization, and we can be better informed about what those steps look like, because a lot of business owners have already had initial steps because of things like the Paycheck Protection Program loans, the economic injury disaster loans through the SBA, smaller city and state grants or loans that have been utilized to plug holes and to assist business owners in their development. And so today's presentation and today's conversation is going to focus very broadly on every one of those steps in what I call the capital continuum. So if we could just go back perhaps to the slide before, again, if just one slide more forward, thank you. PPP worked, largely a success. EIDL was increased to accommodate businesses throughout the country, especially here in New York City. I think the economic injury disaster loan was one of the best products that were out there right now for working capital for small business owners. It's basically a small mortgage that you're getting for working capital, which is very rare and very difficult to access in normal credit markets and in normal times. But you're getting working capital that could range all the way from $30,000 up to millions of dollars. I've seen some businesses get $2 million at 3.75% fixed over a 30-year term. In some respects too, and I think this is another moment where we can start thinking about this as business owners, where we stand on the capital continuum. Rate, I think, is very comfortable to a lot of us because we can understand rate and what that means, and that we don't want to pay a lot in interest pursuant to rate for a small business loan product. But at the same time too, term is even more important, because term gives you a smaller principal and interest payment and a lower monthly payment when you're trying to service that debt. And so what I really loved about the economic injury disaster loan is that long term. I mean, 30 years, again, is like a small mortgage. And so it was giving you 30 years to pay back a loan, and it had a nice fixed rate on top of that too. But if I had to say of those two parts of that product, what was more important, definitely the term, not the rate. With regards to the SBA 7A, that's what we're going to talk about today. And I think right now is a wonderful moment to start repositioning ourselves in why an SBA 7A could be a tool for long-term recovery. And I also think that historically, a lot of business owners have thought that the 7A is cumbersome, that it takes a long time to access. And to a certain degree, some of that is not unfounded. I mean, it is a difficult product. It's more nuanced, and it takes longer than a PPP or an EIDL loan. But I think right now is a wonderful moment to start as a small business owner thinking about a 7A, because the PPP and the EIDL gave a business owner exposure to some of the products through SBA, but then it also gave them the time and the ability to participate in a longer term, more drawn out process that is a 7A. So if we could go to the next slide, I just kind of want to give us a graphic that will orient everybody towards what I'm discussing. We utilize this, we lend throughout the country at National Development Council, and I put this graphic together for some of the lending that I do down in the state of Delaware. And I just wanted to get everybody kind of thinking about steps on a ladder. If we put immediate relief at the bottom of this ladder for PPP, Paycheck Protection, and EIDL, those were, as the equivalent of somebody is, gets injured and they need immediate triage help to get, to stop whatever they're suffering from. That was immediate relief. Then we've seen a slew after that in what I would call the stabilization bucket, which is right in the middle of this slide. And that includes, we've seen in the state of New York, NY Forward, we've seen various grant and city programs that gave $10,000 or $100,000 through NY Forward. That falls into kind of this bucket, if you will, of the SOAR and Delaware stabilization. The way we would term that in New York would be either NY Forward or any one of the city stabilization grants that we saw. And these were designed to provide another shot in the arm after the immediate relief of PPP and EIDL. The last step, though, as a business is fully recovering, is to start thinking about 7A or a 504 loan through the SBA. The SBA traditionally had two products that it offered. It was 7A and 504. The PPP loan, everybody's had exposure to this now, but that was created right in the beginning of COVID, and it was a new product. It worked very well. It was quick, it was efficient, it was easy for the most part, and a lot of people were able to get access to it. But again, I would start thinking about the capital continuum, especially as we think about COVID-19 business recovery, as at least 5 steps. You have PPP, EIDL, you had NY Forward and city and state local grants, and now you're going to start thinking about a 7A. Let's go to the next slide so we can just start diving into more specifically why a 7A would work at this point in time.
And Conor, if I can interject for a second, what kind of businesses have you guys been assisting throughout those immediate relief stages, and which kind of businesses are more, and I know you'll get into this, but just to speak kind of like to the audience, who is better prepared for a 7A loan?
I think we're going to definitely get into that in the presentation, but I guess what I would start thinking about is that the qualification parameters for a PPP and any IDL loan are far more relaxed than for a 7A. But again, if you're thinking about this as an evolution, you can get to a point where you're going to be able to be approvable at a 7A, especially if you utilize your PPP and your EIDL loan correctly. So just kind of the base level parameters about who's eligible for an SBA 7A loan is small businesses that are below the SBA small business size standards or below the alternative size standards. The size standards for SBA, a lot of people fall into that bucket. So, you would have to be a very large business. I'm talking about $10 to $20 million in sales, more than 500 employees to not be eligible for a small business loan with an SBA guarantee. So you can get up to five. Yep.
Sorry, it's the bigger businesses who get out of this, who are kind of cut out of these filters, not so much like the little ones.
That's correct. And I think sometimes a lot of businesses think, well, I have 100 employees or I have $10 million in sales, I'm not eligible. Chances are you're eligible. So a lot falls within that definition of small business. So, if you're getting to kind of a middle market business or a large mid-sized business, you really have to be over $20 to $30 million in sales. You have to have 500 employees. So a lot of people fall or are eligible for an SBA loan product. The maximum loan amount for an SBA 7A is $5 million. So you can get quite a bit of financing. The rates vary, but I think even with climbing rates right now, which the Fed's been talking about rates going up, you're going to get a loan, anywhere between 4.5% to 7%, which is pretty reasonable in today's market. And then again, you can get something as long as a term of 25 years, especially if you're purchasing commercial real estate. For working capital, for equipment purchase, that can be 10 years, which is very reasonable, especially when you compare it to what generally banks and other traditional financing mechanisms would give for financing assets like working capital or like a piece of equipment. Then with regards to security and collateral, it's pretty standard. The SBA is going to require that the lender take liens on all business assets and take a personal guarantee of any owner that has 20% or more ownership in the company. And then eligible uses, I was just talking about them. You can use a 7A for working capital, for purchase of equipment, leasehold improvements, refinance of poorly structured short-term high-rate debt, or real estate acquisition.
On that note, Conor, sorry, I see we have one of the participants who had inquired maybe about, property purchase. I understand the 504, if we're thinking of SBA products, right? That this 504 would be a better product. Why a 7A also for real estate acquisition is my question.
Yeah, I think that's like a long conversation that you could have between like what's better, 7A or 504. Both have advantages to them. Sometimes you can get a slightly more advantageous rate through 504 for real estate purchase, but at the same time too, the 7A can lock in a fixed rate over a longer period of time and you don't have to refinance it throughout the lifetime of a loan. Whereas a 504, you might have to refinance a couple of times, pay soft and closing costs for additional transactions after your initial transaction. So in the market, a lot of people think of 504 traditionally as the better product for real estate purchase. But I've worked with both products and I couldn't tell you, it would take forever. We could sit on this webinar probably for a good couple hours discussing the advantages versus the disadvantages. I would emphasize that I think you can do a 504 for real estate. Of course, you can do a 7A for real estate. What I would do with anything, not just an SBA 7A or 504, is shop it around and see what makes most sense if you're at that level to purchase real estate. Best to get a couple offers and see, what a 7A offer looks like, what a 504 offer looks like, potentially what a conventional loan might look like, and then see which one's going to make the most sense from a cost perspective, terms important, and then the possibility of, like I was saying prior, what it would mean if you had to refinance out that loan again. So
Totally.
I know that's probably not the definitive answer that you want, but it's the honest answer. So
Yeah, no, that's
yeah.
great. We want honest, and also, like the concept of shopping around, alone. That's also something good to keep in mind. But yeah, if sorry if this kind of went a little bit off the tracks. The 7A loan being the traditional growth loan that the SBA offers, right? And that's kind of what we're talking about today.
To a degree, yeah.
Okay. Next slide then.
Sure. So another thing I was trying to say too is, there's very little prepayment penalties on 7A loans, especially under 15 years. There's no prepayment penalty. That's hard to find in other traditional loan products or even on a 504. You can apply for a 7A through any SBA approved lender, and there's hundreds of them throughout the country. At National Development Council, we're an SBA approved lender, but you could, go to your traditional bank and they most likely have an SBA loan program. The underwriting criteria, it varies by lender, but we're going to talk a little bit more today about generally what a lender is looking for when they're trying to underwrite an SBA 7A loan. And a lot falls into the SBA 7A bucket in the sense that you're getting a guarantee on the principal portion of loan funds in the event that this loan defaults. And so this loan product can be used for existing businesses. It can even be used for startups. I would caution the 7A and the 504 are for for-profit businesses. And the only reason I point that out is because the EIDL and the PPP have been utilized for not-for-profits. Mm-hmm. The guarantee it's a little bit higher actually now for temporarily for loans of $150,000 or lower, it's at 90%. And then when you get over $350,000, it is 75% or a 75% guarantee on principal portion of loan funds. So again, this is a mechanism that the federal government utilizes to incentivize lenders throughout the country to diminish their risk and get them to lend to small businesses, because really it's not that the money for the loan is coming from the federal government, but rather if there was a default and the lender, had to recoup some of their loss or some of the default proceeds, they could utilize this guarantee in order to be paid from the federal government on a portion of whatever had been lost. And I think everybody understands that part of the federal government would be the Small Business Administration, the SBA. So when we're thinking about a 7A loan, there's a couple kind of core things I think we need to start thinking about. Any lender, when they're trying to make a decision on this, like I was saying before, it's going to be a little bit more nuanced than perhaps what you went through with PPP or even EIDL. They're going to be looking at a business's cash flow, and we'll talk a little bit more about what that looks like, about how existing cash flow is overlaid with debt service to come up with a ratio and determine repayment ability. They're going to look at collateral, and they're going to try to understand if there's a way to secure either business or personal assets in the event that the loan doesn't pay back through the first means, which is cash flow. And then, of course, they're going to look at character. They're going to be underwriting the personal guarantors and looking at corporate credit histories in order to understand, if we extend debt to this business, will they in fact pay it back? Do they have the character to pay this back? Then they'll also think about capacity. As Michaela was mentioning, this is a growth product, so they want to make sure that the business owners have the ability and the know-how to manage the growth associated with this company in the years to come. So that's the core kind of largest scale concept of what they're looking for when they underwrite a 7A: cash flow, collateral, character. Maybe we could go to the next slide, Michaela. Thanks.
Before we go to the next slide, Conor, would you be willing to talk a little bit about, I brought this question to you a couple of times. SBIDC throughout the pandemic has been, really providing hands-on assistance with helping any kind of business really to access financing, whether it's like some of the city grants that have been available that are, very scarce, but that have their programs that have been open for a while. And part of what I've been seeing is that very few of the businesses that I've been trying to help out have been able to access some of like the more traditional products. So Conor, I don't know if you wanted to talk a little bit to that, to, what's happening with so many people. Especially, I think the main obstacle that I'm seeing is that all these new products, especially for grants, if you're a business that's looking for grants, either the state or the city, they're always trying to see that you are cash flow positive, that you have ability of repayment. And generally that's where we get the answer from the underwriter saying like, no, sorry, this business is not, it was eligible at the beginning, but after we did the analysis, we don't see that they're cash flow positive, or that they show an ability to repay these products. I don't know if you have any thoughts on that, Conor.
Yeah, I think what in the slides to come, we're going to talk about cash flow and collateral. And I think that's going to lace in well to the theme that you're discussing, why a business owner might be getting a denial for a more complicated or a more mature credit product like a 7A.
Mm-hmm.
And I think the way that we have to look at this again is to go back to that capital continuum. As a business matures and scales, it has to start thinking, you don't have to be a business owner that's an expert in cash flow or collateral, but some of these themes we're going to discuss today are definitely themes that should be on your radar to understand why you would be appropriate for a certain product on that continuum, and why you might not be at a certain point in time. And so that's where I think we kind of have to start thinking. And I think that's why we started with this graphic here that you're sharing, but really we're diving into kind of traditional underwriting with regards to cash flow, collateral, and character, specific to what a lender looks at when they're kind of really starting to size at that top level of the ladder. And we're going to dive in a little bit more in nuance in the slides to come. And I think that's going to reveal why you're either eligible for a more mature 7A product or you're not. One of the core things is that a lender is going to start looking at business cash flow, and the way they're going to set it up is exactly the way that you see in this slide right in front of you. They're going to take the net income of the business over a period of time, and then they're going to add back a series of one-time expenditures for depreciation, amortization, for non-cash expenses, interest expense, because they don't want to double count specific to the debt service associated with any sort of existing debt. And then they're going to make add backs if and when they can. They're going to put in existing debt service. So that's existing debt service that might be on the books of the business or on the balance sheet of the business. And then they're going to overlay a proposed new debt service. In this case, we're talking about a 7A loan. And if you look at the little note at the bottom there, it says $200,000 at 5.5% interest and a term of 10 years. So I say all that because what I'm trying to say is that when we think about a 7A product, you need to show the ability to have cash flow support debt. You need to at least show $1 cash flow for every dollar of cash required or debt service that's going to be utilized in the repayment of that loan. So for instance, in this cash flow chart that I'm presenting, and again, we don't want anybody here to become like an expert in underwriting, but we certainly want you to get an appreciation for what people look at when they're making these decisions. So for instance, if you look at the cash flow coverage ratio in 2017, it was 1.09. In 2018, it was 1.15. In 2019, it was 1.23. And then so on and so forth. There's always been cash flow. If there was a cash flow deficit, then it would not be eligible. So this is a yes, but a lot of times business owners just don't have the ability to cover debt based on the cash flow that they're showing. And if that's the case, sometimes you can get a denial. But at least now, I think this helps you to understand from a visual standpoint why you're either getting a yes or a no. And if you're getting a no, that's not a no for now. That means improve the business cash flow, get it to a place where you're going to at least get $1 of cash flow for every dollar of debt service or existing debt service. So that's business cash flow at a glance. And sure enough, that was one element in our decision. In the next slide, we're going to talk about collateral, or rather we're going to talk about personal cash flow and then move on to collateral. But rather what I want to kind of get into the point of here is that when a lender is looking at business cash flow, that's the first concept they're taking into account. Can the business itself, based on its income and then its depreciation and amortization for non-cash expenditures that are going to be added back, its interest expense, can it support debt? That's the first question. Then in the next slide to come, the lender is going to look at personal income and personal expenses and put together what's called a personal cash flow to be certain that a principal or an owner of a company can actually cover their personal living expenses, because it's not enough just to show that the business itself can cover its debt service, but we have to also understand, that these owners of this company can support themselves based on the salary and wages that they're taking from a company. So in this case, we have a salary and wage of $60,000 and then personal expenses related to mortgages, auto, student loans, credit cards. And sure enough, there's a cash flow surplus of $9,300. And they can, in fact, cover, based on the salary they're taking from this business, which was modest of $60,000, they can cover their personal living expenses. These are some of the things that a lender is going to start to think about when they're arriving at a decision or not arriving at a decision. Let's go to the next slide too. So the owner is, or the lender is also going to make a decision based on collateral. So now we're moving off of this concept of cash flow, which we were discussing business cash flow and personal cash flow, which was really getting back at repayment ability. And now we're talking about what a lender would do to diminish their risk, which is kind of their second way out, or what assets they're going to secure in the form of collateral in order to cover their to cover their risk and to insure against a default. So for an SBA 7A loan, you could start thinking about business assets like new machinery and equipment to be purchased, inventory to be acquired, or existing inventory that's on a business's balance sheet, accounts receivable. But also for many of these small businesses, they're going to look at personal assets as well too. And that's why I put up here the owner's primary residence. Oftentimes with a 7A loan, and oftentimes with any sort of small business loan transaction, a lender is going to secure against that primary residence. And take a lien on that primary residence. But in this case, actually, there wasn't a lot of equity or collateral value in this owner's primary residence because they had a fair market value of $150,000 overlaid with an existing lien of $135,000. That probably was a mortgage that this owner had on a property. And so there was zero collateral value, especially after discounting the asset. But this is the type of mix that the lender is going to take into account when they're determining how they're going to secure the loan that they're extending to this business owner. And I just would emphasize that with an SBA 7A product, they have this magical rule that the lender has to secure any and all available collateral. So in this case, if you look at the collateral coverage ratio, there's 0.56 to 1 collateral coverage. This actually doesn't have full collateral coverage of the loan funds being extended, in this case, $200,000 through the SBA 7A loan. But on this front, the lender's still going to say yes to this loan because they have an SBA guarantee and they've followed the rules of the SBA, which is they've secured any and all available collateral. There happens to be a collateral gap, but the lender's not really going to be driven by that consideration. They will be driven by the previous slides where we were talking about cash flow, because that's going to be more important to them because that's the first form of repayment. But because they get an SBA guarantee in this case, even if you have a 0.56 collateral coverage ratio, which again shows that there's not sufficient collateral coverage, they still might do this loan. Let's go on to the next slide.
And let me know if you want me to move quicker.
No, you're fine. You're fine.
Cool.
So we've gone through cash flow, we've gone through collateral, and again, we're throwing out a lot right now. The goal of the presentation is not to make anybody an expert in this, but to at least kind of peel back the curtain and give people an understanding so they understand, to Michaela's point, why there's a yes, why in some cases there's a no, and what you can do to go from a no, obviously, to a yes. With regards to that third item I was talking about, an underwriter is going to look at a person's character and their capacity. They're going to do background searches, personal and corporate business histories and credit histories. They're going to look at client and vendor relationships and many other kind of items that fall on this list. With regards to the capacity of the business, they're going to look at the balance sheet and profit and loss statement, determine if there's adequate working capital on the balance sheet to support operations. They're going to look at key staff and succession plans with regards to how the business will look in 10 or 20 years. And with regards to a startup business, they're going to see if a business owner has relevant experience to be operating in that space or in that industry. So there's a lot here on this slide. I don't really want to get too deep into it, but these are some of the considerations that lenders make when they're thinking about character and they're thinking about capacity. Let's go to the next slide.
And it's interesting to know, Conor, that there is a distinction between startup and established business in terms of those criteria, right, that they're looking at.
Yeah, there's definitely a distinction in the sense that a startup business is missing one of the core things that we talked about in this presentation. They have no existing cash flow. And so with the lack of cash flow, what becomes more important is other factors like industry experience. Does this business owner have what it takes to start something from nothing? Right. And get to a point where there will be existing cash flow to repay the debt? So that's why, at a glance, there's some significant differences between how a lender is going to look at startups versus how they're going to look at an existing business. I mean, one thing to consider too is we were talking about collateral. In the case of a startup business, collateral becomes a more important consideration because there's not existing cash flow. So you can understand if the first way of repayment doesn't really exist whatsoever, then the second way becomes more important. So it's little nuances like this that start to better inform a business owner's lens through which they kind of make decisions or don't make decisions. Go to the next slide here. So I just want to give everybody kind of an example of a deal that we approved through National Development Council's Grow America Fund. We did a 7A loan, and we've obviously done many after this, but in the heart of COVID, we did one for $205,000. There was some issues that we ran into because of COVID-19, and we still found a way to make this deal happen. So again, I would encourage everybody on the call to look at the 7A as that long-term recovery step. So even if your business has experienced some ups and downs through COVID, has seen some decreased cash flow in 2020 because that was the year that everybody was really truly impacted by COVID, don't be dissuaded from applying for a 7A. We found at Grow America Fund and at National Development Council that we've still been able to get towards a yes, even because of some obstacles posed by COVID. Let's go to the next slide.
And Conor, can I ask you,
Yep.
maybe we should have mentioned this before, but you guys are a community financial institution, right? What does that mean in terms of?
Yeah, as a community development financial institution, or a CDFI, is a subset in kind of the world of business lending, in which a lot of different lenders can have that status, but generally the types of lenders that fall into that kind of subgroup have a particular focus on lending in low to moderate income communities. In fact, they're required in order to retain some of their funding from the Department of Treasury to be a CDFI, to lend a certain portion of their funds every year in low to moderate income communities and to minority owned businesses. So that's another kind of industry term, but when you hear that term, community development financial institution, you should think that it's tied to a lender that has a particular focus on lending in low to moderate income communities and then lending to businesses that are minority owned.
Does it mean that you guys also offer lower rates?
I think rate is definitely one of the considerations, and sometimes it does. I think generally speaking, if you're a CDFI, what you're trying to do is come up with like the most advantageous structure for the business. So certainly it can mean sometimes better rate, but more important than rate, like I was saying, to be longer term, because we're trying to do a deal where other lenders might not be able to do that deal. And by giving a longer term or a more competitive rate, what we're really doing too is making it so that we can get closer to that 1-to-1 cash flow coverage ratio and actually get towards a yes, as opposed to be stopped at a no. Right. And especially in low to moderate income communities where resources are less abundant, that can become a really valuable tool because you're able to kind of lengthen out that debt and do deals that other lenders might otherwise not be able to do. When we overlay a guarantee from the SBA on top of that too, then again, the theme is the same, doing deals that otherwise wouldn't be able to be done. Right. I just wanted to orient again everybody towards this concept that we talked about in the capital continuum, and to kind of think about like, okay, what's the second step right now broadly? We know that we had all these different programs that we became familiar with in the last couple of years that were for immediate support, PPP, the SBA's Economic Injury Disaster Program, and then all these other kind of, different funding mechanisms that we could use to get through a crisis. Now we're starting to get to this point where the crisis is easing somewhat, not completely past us, but easing somewhat. And now we have to start thinking about funding for future support. And that's where we start thinking about the 7A, the 504, and SBA has these other programs called the Community Advantage Loan and the SBA Express Loan, and even traditional bank financing. Now that kind of the immediate trauma caused by COVID is lessening to some extent, now's the time to start thinking about more mature or more complex funding for future support.
But on that note, Conor, on, for instance, the traditional bank financing,
Yep.
we've been seeing that not many either banks or CDFIs are offering lines of credit, for instance.
Yeah, you might be seeing that right now, and in which case that's a great use for a 7A. And it's really, if you thought about the traditional bank loan, would be like the sixth step on the capital continuum. So if you wanted to find a way to get towards a yes and not to a no, an SBA 7A loan, you could get traditional working capital for term debt, or term debt for working capital is what we call it, which very much would give you the same benefits at times of a line of credit, and allow your business to have the operating capital it needs to support accounts receivable and to support inventory need, which is very much what you should be using a line of credit for. So a 7A loan can be utilized for term debt for working capital if a business owner was trying to get to a line of credit, but just couldn't access that at the end of the day.
Right. I mean, we've seen very little institutions offering it. So that's kind of why I'm asking the question.
Yep, I think banks are going to be hesitant to get back towards easy approvals with lines of credit because there's still great uncertainty out there. So that's another reason to start thinking yet again about an SBA 7A loan.
Next slide.
So I just kind of wanted to start thinking about, like, how do we start increasing chances towards obtaining a yes on an SBA loan? Be proactive and well thought out, and start thinking about this capital continuum, start planning. An SBA 7A loan generally takes about 2 months to originate and close. So don't expect that same level of gratification or immediate gratification that you got essentially with a PPP or an EIDL loan. And then organize yourself. I think one of the great things that came out of some of what we've had to go through is have those tax returns ready, both personal and business, because that's what a lender is going to be asking for initially. And I'll show you guys in the slides to come some of the core documents that a lender is going to be looking for, so you can just get prepared and organized and have financial statements and tax returns ready. Oftentimes, and I've been lending to business owners for close to 10 years now, they just don't have the documents ready to go. And now that you've been through PPP, now you've been through EIDL because you had to, because of the crisis that we all faced. Now there's really no excuse. Everybody knows they need to have their tax return ready. They need to have company prepared financial statements ready in order to get ready for this process. Let's go to the next slide. Just keep in mind when you're thinking about getting an SBA 7A that the lender has to make sure that there's no adverse change in the business. And this can be a little dicey right now with regards to COVID-19 and some of the other uncertainties in the global economy. So I don't want to get too deep into this slide, but it's just something to think about, that a lender has to certify there's been no adverse change to a business when it's going to close a loan. I do want to go to the next slide though and show you guys what I was talking about when we're talking about some of the loan products, or rather the documents that are going to be needed. And we might have cut that out, Michaela, which is fine. Don't worry about it. But no, don't worry about it. It's fine.
Okay.
So if you go back, we'll just go back a slide or two. Perfect, stop there. Just think about getting those tax returns, both business and personal tax returns. We're in 2022 right now. So if you were going to a lender, you should have 3 years of business and personal tax returns. So it'd be 2019, 2020, and then 2021. And then you just need to get a company prepared financial statement. So that could be a balance sheet and profit and loss statement for the most recent period of 2022. And that can be generated off of QuickBooks or whatever record keeping software that you use. But start thinking about prepping those documents, because like I was just saying, and I don't want to sound like a broken record, there's no excuse now. Everybody's gotten those documents ready for PPP or EIDL, and now you should be in a good position to get those same documents ready as you kind of continue up that capital continuum towards a 7A loan.
And here, what does it mean, identify sponsors?
Which part are you on right now?
On this.
Oh yeah, well, I mean, what we're talking about with identify sponsors is identify advocates and sponsors through the SBA 7A loan process. Your team, Michaela, is a wonderful example of that. I think that it can be helpful to have somebody that has a good understanding of the business and a local knowledge of where the business operates in order to explain that story to a lender. Because at the end of the day, a lot of times what lenders are doing is they're taking business tax returns and they're taking personal tax returns and they're telling the story of you and of the business. And I think it can be important to have advocates and sponsors, or have folks that have a deeper understanding or a local knowledge of your business. In this case, a local knowledge of your business in Southwest Brooklyn, in order to better explain that story to a business owner, or rather to a lender, because a lot of time lenders are looking at a lot of different applications. And once they kind of understand that story, that's another way that you can move very quickly from potentially a no towards actually a yes. So that's just, I know that's a little bit more kind of a qualitative quality in getting towards a yes rather than a quantitative quality, but I just thought it was something, you know, that we should all mention and think about.
Totally.
So that's really the heart of the presentation today. You know, nothing too complicated here, but our hope again is that it gives some of you on the call the ability to start thinking about long-term, how do you get into some of these more complicated, more complex SBA programs that are out there, aside from just PPP or EIDL, because, you know, as we emerge from this whole process, I think that, you know, this is going to be critical in order to continue on and continue, more importantly, with the growth of the business.
Totally.
So with that, this is a shameless plug for National Development Council, this slide. But that's the company that I work at, and we've been in operation for over 50 years. We do a lot of different things. I work for our lending arm, which is Grow America Fund. But some of my colleagues work in our consulting business and our technical advisory business. And then other colleagues of mine will work on syndicated tax structures and affordable housing structures in the communities that we work in. So it's a little bit more about NDC. But with that, maybe we could just kind of open it up. If anybody has any questions, I'd be more than happy to answer some questions.
Absolutely. I'm going to stop sharing. Thank you so much, Conor, for that. That was a great presentation. And
sure.
Yeah, you covered so much. Yeah, I just wanted to see if there's any questions from folks in the audience. I see a couple of the businesses that we work with, so thank you for being with us. Yeah, and Conor alluded to it, but I forgot to mention it at the beginning. Our organization works primarily with businesses in Southwest Brooklyn, in the neighborhoods of Sunset Park, Gowanus, and Red Hook. So yeah, opening the floor up for any questions. Laura, you unmuted yourself. Do you want to ask a question?
Yeah, if I could, thank you so much for organizing this. I wanted to ask, when you log on to your SBA account, there's, I think what I see is for the EIDC. That might be incorrect, but I believe it's EIDC, and there's like a loan amount, that's like a max loan amount. I believe we have, in our case, we have to submit paperwork for that, like to complete that loan. But how does that loan amount that's there available on your SBA when you log in, how does that affect, also, if you wanted to take out an additional loan with a local lender for a 7A or the 504?
Are you talking about for your EIDL loan? Is that when you look on?
Oh, sorry. Yeah, EIDL, sorry, that's the one.
Oh yeah, no, that shouldn't impact you at all. I mean, a lot of folks have gotten PPP and EIDL. So the EIDL loan, the only thing, Laura, is that it would be utilized as part of your debt service in calculating that business cash flow that we were discussing earlier on. So it's just an additional debt service that would be calculated in that existing debt service. But at a 30-year term with that reasonable rate, it shouldn't impact your debt service too significantly. And, you know, shouldn't impact whether you get towards a yes or a no. If anything, I would think that a lender might look at it positively because it's such an affordable long-term form of working capital that it should help to better support your balance sheet and how you finance things like accounts receivable, inventory, the cash balances you have on hand in order to cover operating expenses. So it should be a positive, not a negative.
On that note, Conor, can you use one to finance the other?
I'm not, like, in what sense would like
the IDL loan, if you received it, but you want to request more funding through the 7A loan, can you use the 7A to finance the debt of the IDL? That was one of the questions we got frequently when we were managing PPP and IDL. Folks were.
I don't think you might. I don't think you would want to do that because first off, it's not eligible from an SBA standpoint. But also, like, if you're getting money at 3.75% fixed over a 30-year term, trying to refinance that out with another product would be nearly impossible because you would never get something of that rate in that term. So not only is it not eligible from an SBA standpoint, but it would be not in the economic interest of a business owner to do something like
Right.
that.
Thank you.
When a business is looking to obtain a 7A loan, how long is the timeline of that process from when they first kind of start becoming interested in it to reaching out to potential CDFIs or banks to actually getting that loan?
Yeah, like I was saying earlier, it's going to be a 2-month process, and oftentimes it's 2 to 3 months. So I think it's definitely something to start orienting yourself towards and digesting a little bit more of, because there's been so much of late with regards to PPP and EIDL that people have almost in the market gotten used to kind of that immediate yes. This is not that. That's not to say it's bad though. I mean, you're going to get well-priced long-term capital that can help you grow a business. But it's time that we start reorienting ourselves to the fact that the stimulus programs of COVID are passing. Business owners had access to those. More traditional products that are coming off the balance sheets of banks or of more of lenders like CDFIs, that's not a stimulus program. That's a more traditional program, and it's going to be underwrote a little differently, and it's going to take a little bit more time in order to quantify that risk and to go through that process. That's not a bad thing. That's just kind of a normal thing. And I just kind of would caution folks, just start thinking about that a little differently, because if you're looking for that kind of quick process that was just really quick through PPP because the underwriting was simpler, there wasn't a cash flow analysis, there wasn't a collateral analysis, this is going to be a little different than that. And again, I think that's the point of the presentation, just to think about why that would be different at this point in time.
Any other questions?
I have another question if it's okay.
Totally.
Yeah. Lori, there?
Yeah, we can't hear you, but you're not muted. Oh, I think we lost you, Laura.
If she comes back, we can get the
yeah.
question.
Or if you want to put it on the chat, that also works.
All right. Oh.
But how do you look at individual assets for collateral?
Yeah, that's going to get back to that point that I was making through the collateral analysis. They're going to look at any and all available assets on both the business side and the personal side. So if there is a personal residence or some sort of significant personal asset, that's going to be taken into account. And it could be part of what a lender requests in the collateral analysis. So that's a great question and a good point at which to start thinking about this within the context of trying to get more traditional loan products. And that's going to be pretty standard, with all SBA programs. So just something to think about and prepare yourself with. Nobody ever, as a principal of the business, likes to think about using personal assets in a transaction, but pretty standard. Good to prepare yourself now, because that question definitely will come up when you go through the lending process.
Thanks for the question, Laura. Hope that answers. Any other questions? Last time I'll ask. Yeah, totally.
Is that all the questions? That's okay if that is. You can always answer them after the fact too.
Totally.
Cool.
Conor, do you want to put your email in the chat?
Sure, not a problem at
all. Well, I think we can give everyone a couple minutes back. Conor, thank you so much for being with us today.
Thank you.
And this excellent presentation. You answered a lot of my questions, trying to help businesses with financing in this last couple years. Just as a reminder, we have 3 other sessions coming up. They're in, let me see if I can. Maybe Brady, if you can share on the chat, the link for registration. This presentation, cool. This presentation by Conor was more advanced financing, right? Thinking for businesses who are thinking about growth. We're going to have another session I'll be leading on the 15th. That's for businesses who are starting and, to think about questions such as like, do you want to take more debt? You know, calculating some of like the interest rate term, etc. So that's going to be on the 15th. And then we have 2 other sessions coming up. Brady, do you want to speak to those?
Yeah. Next, this coming Tuesday, a week from today, we've got Rania Sedham, who's an employment attorney, and she'll be speaking about what sort of employment law issues you might want to keep in mind with changing COVID regulations and circumstances. Then on Thursday, we've got, so a week from this Thursday, we have real estate broker Rich Novak and real estate attorney Justin Wazer, who will be discussing the kind of basics of what you should be thinking about in assembling a team, as well as the state of the current market when you're looking at industrial leasing.
For new leases. So thank you everyone for being with us. I hope you find it helpful and have a wonderful afternoon.
Thank you.
Thanks.
Thanks, everyone. Thanks, Connor.
Bye.